studying your last two. I swim med tea when they turned in. The styrene down to mute. And can lend a pole that sunk he died.
One of the biggest differences between salary and dividends is how taxes are collected and remitted to the government. Many corporate owner-managers are familiar with the payroll system. When a salary is paid, the employer is generally responsible for withholding amounts at the source. These deductions may include income tax, Canada Pension Plan contributions, and other required payroll remittances. The employer then sends those amounts directly to the government, and the employee receives the remaining net pay. Because this process happens automatically, employees often have a significant portion of their taxes paid throughout the year before they even file their personal tax return. Dividends work very differently. When a corporation declares and pays a dividend to a shareholder, there is generally no payroll system involved. The corporation is not usually required to deduct CPP contributions from the dividend. Employment insurance deductions do not apply. In addition, the corporation generally does not withhold personal income tax from the dividend payment before distributing the funds to the shareholder. As a result, the shareholder typically receives the full dividend amount at the time the payment is made. This difference often surprises owner-managers who are accustomed to salary payments. Because no deductions are withheld, it can appear as though there is no tax consequence associated with the dividend. However, that is not the case. The key point is that dividends and salary follow different tax collection systems. Salary taxes are often collected throughout the year through payroll remittances. Dividend taxes are generally dealt with later through the shareholder's personal tax reporting process. That is why the question in the center of the slide is so important. Are dividend remittances required? In most situations, the answer is no. Dividends generally do not require payroll source deductions or payroll remittances in the same way that salary payments do. However, this does not mean dividends are tax-free. It simply means the tax is often collected through a different process and at a different time. The key takeaway from this slide is that dividends and salary operate under separate tax payment systems. Salary usually involves source deductions and payroll remittances, while dividends are typically paid without payroll withholding, allowing the shareholder to receive the full dividend amount when it is paid. One of the most important misconceptions about dividends is the belief that if no tax is withheld when the dividend is paid, then there will be no tax to pay at all. In reality, the absence of payroll withholding does not eliminate the shareholder's personal tax obligations. It simply changes when and how the tax is collected. The process begins when the corporation declares and pays a dividend. Unlike salary payments, there is generally no deduction for CPP, no employment insurance deduction, and no payroll income tax withholding at the time the dividend is paid. As a result, the shareholder typically receives the full dividend amount immediately. For many owner-managers, this can create the impression that the dividend is somehow tax-free. However, the tax consequences have simply been postponed rather than eliminated. As time passes, the corporation prepares its tax reporting information. One of the key documents involved is the T5 slip, which reports the dividend income received by the shareholder during the year. When the shareholder later prepares their personal income tax return, the dividend income reported on the T5 is included as part of their overall taxable income. At that stage, the Canada Revenue Agency calculates the individual's tax liability based on all sources of income, including salary, dividends, investment income, and any other amounts reported on the return. Depending on the shareholder's overall tax situation, additional tax may be owing. In some cases, the shareholder may receive a tax bill or have a balance owing when the return is filed. This is why the warning at the bottom of the slide is so important. No tax withholding today does not eliminate tax tomorrow. The timing is simply different. Salary taxes are often collected throughout the year through payroll deductions. Dividend taxes are frequently settled later when the personal tax return is prepared. For this reason, many accountants encourage owner-managers to plan ahead. Setting aside a portion of dividend payments for future tax obligations can help avoid cash flow problems and unexpected tax balances when filing season arrives. The key takeaway from this slide is that dividends may be paid without payroll deductions, but they are not free from taxation, even though the shareholder receives the full dividend amount initially. Personal tax obligations may arise later when the dividend income is reported and assessed through the personal tax return process. The final point to understand about dividend taxation is that even though dividends generally do not require payroll remittances when they are paid, they can eventually lead to future tax payment obligations. This slide illustrates the timeline that many corporate owner-managers experience. The process begins when the shareholder receives a dividend from the corporation. At that moment, the shareholder typically receives the full dividend amount because there are generally no payroll deductions, no CPP withholding, and no income tax withheld at source. The next step occurs when the shareholder prepares and files their personal income tax return. The dividend income is reported using information from the T5 slip issued by the corporation. Once the return is filed, the Canada Revenue Agency reviews the information and calculates the individual's overall tax liability. This calculation considers all sources of income, including dividends, salary, investment income, and any other taxable amounts reported during the year. Depending on the amount of income earned and the taxes already paid, the shareholder may discover that an additional tax balance is owing. For some individuals, this may simply result in a one-time tax payment. However, if the balance owing becomes large enough, another consequence may arise. The CRA may require the taxpayer to begin making tax installment payments. Tax installments are essentially advance payments toward future personal income taxes, rather than waiting until the next tax return is filed. The taxpayer makes periodic payments throughout the year. These installment payments are commonly made on a quarterly basis. The goal is to help ensure that taxes are paid gradually rather than accumulating into a large balance at year-end. This is why tax planning becomes so important when receiving significant dividend income. A shareholder may receive the full dividend today, but part of that money may ultimately be needed to satisfy future tax obligations. Notice the practical advice shown at the bottom of the slide. Many experienced accountants encourage clients to estimate their tax liability early. Set aside a portion of dividend income for taxes, and maintain organized records of T5 slips, assessments, and tax notices. This proactive approach can help avoid unpleasant surprises when tax returns are filed or installment requirements arise. The key takeaway from this slide is that dividends may not require immediate remittances, but future tax payments should always be considered. Receiving the full dividend amount today does not eliminate future tax obligations, and larger dividend amounts can eventually create personal tax installment requirements that must be planned for in advance.